Tax structures explained. Welcome to Crypto Tax 101, brought to you by Binance Australia. I'm Patrick from Crypto Tax Calculator, and I'm here to help make crypto tax a little simpler for Binance users in Australia. Today, we're going to explain some of the most common tax structures discussed online, highlighting the benefits and the disadvantages. To start, I just want to say that I don't want to be the bearer of bad news, but some of the commonly pitched techniques are not as effective as you may think. 1. Starting a trading business to reduce your tax burden. This one isn't as effective as it may seem, and is a lot of work to set up. Most professional crypto traders are sole traders, meaning they don't use a company or trust to do their trading activities. They do it personally. In some cases, trading losses can only offset the business earnings and not other income like salary and wages. These are called the non-commercial loss rules. Unless you pass certain tests, you cannot claim trading losses against personal income. They can only offset business earnings. This means that if you set up a crypto trading business, any losses incurred from trading can only be used to offset profits, which does not help in a scenario where the business made an overall loss for the year. For example, Jim works for a company and gets paid a salary of $100K a year. Jim trades a lot of crypto, and he decides to start a crypto trading business as a sole trader called Jim's Trading at the end of 2021. Jim makes some losing trades at the start of 2022, finishing up with an overall loss of $20K for the financial year. Since Jim has paid about $37,000 of tax on his $100K salary, Jim is wondering if he can claim his business's crypto losses against his own income tax. The answer is maybe. Jim needs to first determine if he was actually a business in the first place, considering he wasn't very successful. He may pass a less than $250,000 income test in the non-commercial loss rules, but Jim will need to get advice from his tax advisor. If Jim can show he was in business and passed a test in the non-commercial loss rules, he can offset the trading losses against his personal income. If he can't pass, those losses are carried forward to use against future trading profits only. As you can see, this tax structure may not be as effective in Jim's situation. Additionally, it is important to note that business is a grey threshold test, and you should get advice on when a trading business starts for tax purposes. 2. Can you move countries to avoid paying tax? Not really. When you decide to move, you have a choice between triggering a capital gains tax event on the day that you leave, using the market value of your assets, or deferring it, which means those assets will always be subject to Australian capital gains tax. A key point to note with the deferral option is that you'll have to pay non-resident tax rates, which means no tax-free threshold, higher tax rates, and changes to the long-term capital gains discount from when you leave. Additionally, if you owe a lot of tax in the past financial year, you will still owe that tax even if you move country. There isn't a lot of benefit to moving countries unless you're planning on making a lot of gains in the future and want to be in a tax jurisdiction with lower tax rates on crypto. 3. Self-managed super. Crypto can be held within a self-managed superannuation fund, and many Australians are beginning to add digital assets to their super portfolio. Gains made in your super account are a bit like a forced hodl. You can still sell and trade that cryptocurrency, but it will need to remain in your super until you're of retirement age. This is not a last-minute strategy that you can use after the fact. It must be planned and utilized from the beginning. So there you have it, some common tax structures laid out in plain English. What you may have thought was going to save your bacon at tax time may not be that smart at all. If you're trying to understand and manage your tax burden, speak to a tax professional before you get yourself in a sticky situation. Keep watching the Binance Australia video series, Crypto Tax 101, to learn more about how crypto is taxed in Australia. The next video will cover, do I get taxed on lost and stolen crypto?